Hello, welcome back guys. In this video we are taking a look at a company that I considered very interesting, and it's one that I added to my portfolio, the portfolio video that I made about a week ago. If you haven't watched that, I'm gonna be linking to that at the end of this video. So after watching this one, you may want to take a look. I promise you it's an interesting one. And Inmode is a company that has been down about 71% since its 1 year high. You can kind of vividly see that here in our chart using our tool. And the thing is, at this price level that it is right now, sitting at 29 bucks, we do need to examine whether its valuation is overall looking nice enough to buy it at this current price. And you will see that we are already having some nice things over here and a lot of green, because the P ratio and the price to free cash flow ratio, they both converge. And the thing is, they're also going lower and lower. And this is obviously the thing that we love to see from companies that we are purchasing. And of course, this combined with the fact that the company's revenues are still growing massively over here. Same thing with their net income, free cash flow, and total equity. Of course, total equity is a little bit of a thing that we're going to be talking about. But the fact that the company is still growing nicely overall, definitely makes up for a PE ratio that is not like the cheapest one, I should say, but it's still pretty cheap. And again, coupled with the fact that the company is increasing its key metrics here, that's a nice thing to see. Now, there are some bad things about this company as well. Now, for instance, the outstanding shares. The company has been issuing tons of shares, especially from 2019 to 2021, as you'll see here. After that, it has kind of flattened a little bit. And just by looking at this, you can kind of tell what the price of the stock is going to be looking like. Because as the price of the stock was increasing, the company was issuing shares. Then when it started going down, they stopped issuing shares. And this is exactly what you're seeing here. Since 2021, like November over here, it exactly matches the outstanding shares. They started printing less of it because now the stock price is dropping and it doesn't make a ton of sense to actually be issuing a lot of shares on the cheap. And so this is why it makes more sense to be buying at these levels over here. But again, you have to take it with a little bit of a grain of salt over here, because the company has some history of issuing shares here. So if it goes, if it goes up again, or if it starts going up and you buy at the low levels, you may still be kind of diluted over here, or actually even massively diluted. So the fact that the board is printing shares is not the best. Yet the fact that this is a new company and it requires funding, it's generally speaking something to be expected. And I do love the fact that the company has been increasing pretty much all their top and bottom lines here. As you'll see, they are doing better and better. And still, these key metrics here, these valuations are not expensive, and I like to see that. Now, the company is very solvent as well, because they have been funding themselves through free cash flow that they generate, because they're positive, nice to see, and also the fact that they have been printing shares, of course, the thing that we talked about, so funding themselves through that. Now, their margins are huge, as you'll see here, and that's a great thing. Another thing to actually notice here that's important for buying a company of this sort, and a company that is still on the cheap, even after having these amazing margins, obviously awesome return on equity over here as well. Now we're going to take a little bit of a closer look at the financials, what's going on with the statements here. The company had a revenue of 53 million, increasing it to 357 million over here. Very nice increase through the years, especially the last couple of years here. And you will see that the net income from 8 million to 165 million over here. As you'll see, the company is doing very nicely through the years. And the balance sheet of the company, of course, you will notice that they have been pretty much having some additional paid-in capital because of the shares issuance, as expected, of course. But overall, their total equity is sitting at about $500 million over here, and the total liabilities are 62 million. Very little total liabilities, really. And if you take a look at the cash flow statement, it's something very nice here. You'll see that they have a ton of free cash flow. That's actually much more than the total liabilities. Another nice, very nice thing to see here. And you will see that the net cash from operating activities for the company is sitting at about 175 million over here, after it being adjusted for pretty much non-cash items here. And when you take it to free cash flow, after excluding the capital expenditures over here, which are just a little bit, you will see that we are sitting at a very comfortable 174 million over here. Very nice metrics here for the company, which I love to see. So overall, we're dealing with a company that seems to be doing rather well through the years, and getting better and better results. And that's exactly what we'd like to see. The only thing that has looked bad so far are pretty much the shares that the company has issued, the extra shares that they have been printing through the last couple of years or so. Now, it was rather interesting for me to see the institutional holders for Inmode, and especially this handy little table here, which tells you how many investors are actually pretty much holding and the total ownership levels of the company. And as you'll see through the years, there have been more and more investors, institutions, I should say, holding pretty much and increasing the ownership of the company in terms of institutional holders here, which I thought it's fairly interesting to at least take a little bit of a look at. But of course, what we really need to be examining is what the company, what I should say the stock, is actually worth based on its current valuation. And this is where our handy little stock evaluation tool comes into play and will help us actually determine what the value of Inmode is. Now, the company is still growing at great levels. Of course, this revenue growth is not going to be happening for the next 5 years, but we are expecting, and analysts are expecting, to have a pretty nice revenue growth for the company at least like 10 to 15% a year, at least, pretty much for the next 5 years on average. So I'm going to go there. I'm going to go 10, 15, and 20 over here. And in terms of the net income margins of the company, you will see that they are getting better and better and better, which is amazing to see. And you do expect that as the company becomes better with their operations, starts becoming more and more profitable, you do expect them to have better margins. And so I'm going to go just a little bit lower around this last year pretty much and go like 40, 42, and 44 just to be a little bit safer, of course. Now, in terms of free cash flow margins, comfortably sitting at more than 100% here, another great thing to see for the company. So I'm going at 90, 100, and 110. And 13% for my annual return is what would make a ton of sense here. Now, again, remember that you can pretty much do your own evaluation here. You can gain access to our tool by becoming a Patreon. The link is in the description box below this video as usual. And you can pretty much try your own projections and estimates here and see where you'd like to take this company. Too, pretty much. So do you like to try for less revenue growth, less net income margins? You can kind of try all your own scenarios. But I think the projections I'm doing here make a ton of sense for what the company has been achieving. And of course, I can't just like make hundreds of projections here. The video will never end. So if we hit calculate with these ones, which I think make a ton of sense, let's see what we're getting here for Inmode. Now you'll see that our current price is sitting at 29, and even our low estimates here are sitting at a comfortable 32 almost. The medium ones at 45 and the high ones at 63. So based on what I'm saying here, the company is a comfortable buy. And again, remember that we did have the thing about the outstanding shares. That is a little bit of a burden here. The fact that the company's outstanding shares are rather high and have been increasing through the years, but the fact that the company has been kind of stalling its share issuance may be a nice little opportunity for us to potentially buy at this level, as the stock has been going down precipitously again, and potentially gives us an entry point. And this is why I wanted to add this one to my portfolio, and I bought it a few days ago. And we'll see, of course, what it's going to be doing, but I think it's an interesting opportunity here for adding a little bit of Inmode. Now, remember, these kinds of companies are always a little bit more risky. They are not like your typical companies that have much less risk. This one is going to be a little bit riskier, and you can even see it in the company profile of this company. And you will see that it designs, develops, manufactures, and markets minimally invasive aesthetic medical products based on its proprietary radiofrequency-assisted lipolysis and deep subdermal fractional radiofrequency technologies. So as you can understand, this is a very specialized healthcare company that could do very well through the years, especially having some proprietary technology here. But it doesn't come without risk. These kinds of companies do have a lot of risk, especially healthcare can have a lot of risk, of course, or biotechnology. They could do very well or they could do very badly in some situations. So if you are to be taking this one for a ride, I generally recommend to not overdo it. Don't hold way too much. Just be safe with your portfolio. Hold just a little bit, as much as you are comfortable holding, and let it ride through the years. The fact that the company is making good money here, and basically the fact that the stock price has been going down so much, potentially offers a very nice opportunity, and I really wanted to add a little bit to a portfolio here, and this is why it's been in my latest video pretty much. I want to thank you for watching this video. I hope you enjoyed this kind of analysis, and if you haven't watched the video that I talked to you about earlier, you may want to take a look at this. It's a video that I created again about a week ago, and I'm discussing how to set up a full-blown portfolio there, which I have online as well. So you can open up the video and even see the portfolio as it's going through the months, I suppose, and pretty much see what I bought there. But you may want to take a little bit of a look at the video just to see the reasoning behind all that, because I have prepared the full-blown PowerPoint and everything, which patrons have access to as well. So I'm linking to that video here, so take a look at it after this one. And thank you for watching this Inmode video. I'll see you in the next one. Bye bye for now, guys, and I'll see you soon.